Hello everyone, this is chapter 15, Raising Capital. This chapter we will see how companies' new stocks are issued and sold. When a firm decides to sell securities to public, the first step is to obtain permission from the board of directors of the company. Then the firm files a registration statement with the Securities and Exchange Commission, SEC. SEC examined this registration for 20 days, called 20-day waiting period. During this period, stocks may not be sold, but a preliminary prospectus called a red herring is distributed. If there are problems, then the company may amend it. If so, the waiting period starts over. After the waiting period, price per share determined on the effective date of the registration and the selling effort begins. The stocks may be sold as a public issue or a private issue. If a firm wants to sell its shares to more than 35 investors, it should file registration with SEC as we saw. If stocks are sold to general public, it is called general cash offer. If the offer is only for current shareholders, it is called right offer. When a firm publicizes its stocks for the first time, this offer is called initial public offerings, IPO. Only one IPO per firm is possible. After IPO, any equity offerings are called seasoned equity offering, SEO. If stocks are sold to fewer than 35 investors, it is called private issue. Private issues do not have to be filed to SEC. Since an issuing firm is not expert to sell new stocks, it hires investment banks to underwrite offerings. The underwriters formulate method to issue security, price the security, sell the securities, and stabilize price in the aftermarket. The investment banks form a syndicate which makes underwriters share the risk associated with selling the issues. And they receive spread, which is difference between what the syndicate pays to the company and what the security sells for in the market. There are three typical ways to underwrite. First one is firm commitment underwriting. Firm commitment underwriting is that an issuer sells entire shares to a syndicate and the syndicate resells issues to the public. Underwriters makes money on the spread between the price paid to the issuer and the price received from investors when the stock is sold. The syndicate bears the risk if it is not be able to sell the entire share issues for more than the cost. This is the most common types of underwriting in the United States. Second way is called best effort underwriting. Underwriter makes the best effort to sell the securities at an agreed upon offering price. So an issuing company bears the risk of the issue not being sold. Offer may be pulled if not enough interest at the offer price. The risk is that the company does not get the capital and they have still incurred substantial flotation cost. So it is not as common as it used to be. Third way is the Dutch or uniform price auction. It is a bidding system. Buyer bid the price and number of shares. Then a seller works down the list of bidders and determines the highest price at which they can sell the desired number of shares. All successful bidders pay the same price per share, which may encourage aggressive bidding. For example, the company wants to sell 1,500 shares of stocks. There are 5 bidders and bid the price and number of shares as shown in the table. If you cumulative quantities by the order of highest bid price, bid A, B, C, D can get the stocks. The price they pay is $15, which is the lowest bid price among winners. This is called Tombstone. This is for World Wrestling Federation Entertainment Incorporated. It shows number of shares that indicate sale, 11.5 million shares, and the offer price, $17. 9.2 million shares are offered in the US, and the 2.3 million shares are offered in international markets. Investment banks in the syndicate divided into brackets, and firms listed alphabetically within each bracket. The investment banks in higher bracket has greater prestige since underwriting success built on the reputation. The lead underwriters of the US offerings are Bear Stearns, Credit Suisse, Merrill Lynch, and Wood Capital. In international offerings, there are 3 underwriters. To avoid the risk, IPO often has over-allotment option called green shoe provision. It allows the syndicate to purchase an additional 15% of the issue from the issuer. By doing so, it provides some protection for the lead underwriters as they perform their price stabilization functions. We can find it in all IPO and SEO offerings. There's also the agreement that insiders are prohibited to sell IPO shares for a specified time period, commonly 180 days. It is called lockup agreement. Stock price tends to drop when lockup period expires due to market anticipation of additional shares sold in the market. One of the most critical functions that underwriters do is to find the right offer price. IPO pricing is very difficult because there's no current market price available. In many cases, we can see underpricing IPOs. On the first day of IPO, price immediately rises. It means that the company does not raise these differences, often called the leave money on the table. Dutch auction is designed to eliminate the underpricing. To minimize the opportunity cost of underpricing, during SEC registration, a company will set a file price range. And just before the IPO, the final price is determined. The final price can be below, inside, or above the file price range. Historically, IPOs with a final price above the file range have been far more underpriced than those with a final price below or inside the file range. Why are IPOs generally underpriced? The best possible explanation is underwriters want offerings to sell all shares out. Reputation for successful IPO is critical, and underpricing is basically an insurance for underwriters. There's called winner's curse. Investors have different information about the fair value of the shares. So, informed investors only buy new shares if the share issue price is less than fair value. For uninformed investors, share must be offered at a discount because none of investors group have enough money to absorb the initial public offerings. Therefore, IPOs are generally underpriced, especially smaller, riskier IPOs underpriced attract investors. Since the IPO underpricing generate the opportunity cost to the firm, this would be one of the most expensive costs to raise capital through IPO. Pop quiz. If the company wants to sell 1,000 shares, find how many shares each bidder can get and how much each bidder will pay per share. Bidder A will get all 500 shares. Bidder B will get 400. And C still get the shares, but not 250 because company is selling only 1,000 shares. C will get 100 shares. Now, since C is the winner who bid the lowest price, $16 will be an offer price. This is the end of the chapter 15. Thank you.